I'm still going to try to excite you once in a while about a topic such as Solvency II. The first question that was asked already is, who is the mother of Solvency II? Well, I must admit, ladies and gentlemen, that you have in front of you both the father and the mother, because my first name is Karel. In many countries in Europe, this is considered to be a female name. So very often I'm on the program as Miss, which I then contradict by showing my beard, which makes it quite clear that I am not a Miss, but a Mr. But that means that I'm both the father and the mother. That solves your first question, Mr. Chairman. Insurance is about risk. People are naturally risk averse. And they need to be reminded to protect themselves against risks. It starts already when you get married, you know. Should you conclude a wedding contract, a marriage contract? Most people say, I'm in love, but you need, then the lawyers come in and they say, you need to conclude a contract to protect yourself against risks. Not all risks are equally important or should be insured. A big problem in the insurance market today is that insurance companies, I believe, are selling too many products which we don't need and not enough products that we really need. And we can discuss that if you wish later on. Life would be unlivable if everybody would have to take care of all risks. Very important if you look at retirement. I retired from the European Commission in 2013. I'm still working full-time. The day will come that you will also retire. But then the question will come, can I continue to live as comfortably as I used to live before? The likelihood that that would be possible is not very evident unless you start preparing for that in time. And the question then is, can you rely on people to do this exercise? And this morning I told the brokers how important their role is in society, but this is one of the elements where insurers can play a role in convincing people that they need to take care of their risk and that they need help to do that. Insurance industry, and I mentioned some of the risks that are outstanding, that are going forward, going to be very important for society, where I believe only the insurance industry can help public authorities to deal with that. The conclusion is the insurance sector will be the sector of the future if it can offer solutions for these challenges. That's the proviso, of course. Insurance and regulation. Present insurance regulation, this of course is Solvency I, is boring. Solvency II is exciting. Try to explain to anybody how to calculate the solvency margin under Solvency I. When I was asked in the European Commission to take up insurance, I asked one of my staff members to explain to me Solvency I. I never heard about Solvency I before. And after a while I said, stop. I'm not going to learn it. That's not interesting. Solvency II, by the way, is completely different because it has a logic in it. And that logic needs to be understood. But Solvency I is a good example of regulation in insurance, which is extremely boring. And most people are not excited at all if you propose to them to work in insurance. I have no student who comes to me and says, Professor, I want to work in insurance. I've never met anybody in the insurance world who said, when I was bored, the first thing I told my mother, I'm going to work in insurance. It all happened by accident. Insurers are often perceived by regulators as people who sell just about anything. Insurance is indeed looked at by many people as the guys are selling you something. You know, they don't know what they sell, just buy it, you know, to get them off the hook. Insurance regulation is highly prescriptive and paternalistic. The old Solvency I world was a world where the supervisor was running your business. He was saying how much you could invest in whatever, what products you could develop and so on. Under Solvency II, that responsibility passes on to you. More excitement, more interesting. Very legalistic, because too many lawyers involved in that. It does not reflect the economics of the insurance business model. I can develop for you as a lawyer the perfect policy that caters for any eventuality, but you wouldn't be able to sell it because it does not respect the business model. I mean, you can't protect yourself against all the risks. Insurance regulation is more concerned with policyholder protection than with insurance. That's what we see today. It's not about, do we need insurance? How can we develop an insurance world that actually can take care of all these risks? No, we want to have absolute protection for anybody, for everything happening. And that, of course, is not right. The insurance industry. Industry representatives are rarely capable to explain to outsiders in simple terms what insurance is all about. I experienced that when I was developing Solvency II. And the whole industry, the lobby came to Brussels to talk to my commissioner. It was terrible. I knew after 1 minute my commissioner's attention slipped already away. Do I have to listen to all these things about how to calculate the discount rate? Now, what is important is not how to calculate the discount rate, is what is the relevance of the discount rate in this debate. Insurers have difficulties to explain that to outside people. Although the introduction of a risk-based solvency regime has been announced for a long time, many insurers have still not changed their behavior. I remember, you may remember that a couple of years ago, it was 2012, we were negotiating Omnibus 2. Omnibus 2 was the proposal that the Commission made after the financial crisis to increase the powers of EIOPA, and that was also dealing with transitional measures and long-term guarantee business. At that time, I swear to you, many insurers told me this is the time to get away from Solvency II and back to Solvency I. Because we had a financial crisis and the industry survived, although they were under Solvency I, which you, they point at me, say is a bad regime. And I told them, of course the industry lived through Solvency I. Because the solvency margin didn't show anything about your real capital position. Many of the insurers are virtually bankrupt today in Europe. But they didn't know under Solvency I, they could still have a solvency margin of 200%. That was the problem. The industry wasn't always so excited about having a more developed system. We needed to have a long-term transition period. I remember when I proposed 16 years, people looked at me, 16 years transition? You must be out of your mind. I can tell you, you will need those 16 years. And you'll be happy it's not 12 years. 16 years you will need them. The absence of proper risk management and a well-developed risk culture with the right tone from the top was the important reason for the delays in Solvency II. The industry was very often defending old practices, old products, old behavior, and at the top of the companies, there were very few people, CEOs in Europe that came out and said, it's time that we change, it's time that our industry becomes progressive, that it is forward-looking and not continues to do in its conservative attitude of the past. One of those CEOs is the CEO of Munich Re, who was a very strong supporter of Solvency II, and still is, by the way. The birth of Solvency II, the most important change in the last 30 years, so you should all be happy. I mean, you are experiencing something historical in Europe. For the first time in Europe, we take care of insurance. You can criticize parts of Solvency II, and there's no doubt you can do that, but this is something we really take care of you. You know, it's not just a marginal change. The capital market crisis helped us a lot. At the beginning of this century, many insurers in Europe were virtually bankrupt because they had heavily invested in the equity markets. And as market risk was not included in the calculation of the solvency margin, you know, they could do that. Crucial elements are the introduction of an economic risk-based approach. An economic risk-based approach. Ladies and gentlemen, today you can read many people already saying one of the biggest mistakes that Solvency II makes is a market consistent valuation of assets and liabilities. That's an economic approach. If you read the industry's response to the Commission's proposal in 2007, the industry's response was, Solvency II will only become for the industry what it pretends to be if it follows strictly an economic risk-based approach. After the financial crisis, insurers came to me and said, Karel, do we really need to take account of market risk? I said, what do you want? You want an idealistic world or you want a a real world. But that's the issue, and that's still today. The whole debate is about market risk. How do you calculate market risk? It's not evident. Linkage between risk and capital. Many insurers in Europe were selling products that were not properly understood in terms of the riskiness, promising high guarantees for which they did not have the necessary capital. That's the biggest change. If you have good risk management, and today it's about risk management, a company that has good risk management will never operate with not enough capital, because that's contradictory. Risk management is absolutely crucial. And a move in this direction is recognized throughout the whole world. And when the chairman said that I am a member of the board of the Bermuda Monetary Authority, why am I a member of the board of the Bermuda Monetary Authority? Not because the sun shines as contrary to Romania here, but it is because Bermuda has actually developed legislation which is equivalent with Solvency II and was recognized as such. That's where the reinsurance business is based. Many of you are reinsuring yourselves, maybe you don't know it, through reinsurers in Bermuda. We want to make sure that these are properly supervised, and that's important. This is Solvency II. I always tell my students, if you know this slide, you don't need to know anything else. Because what does the slide tell? Very simple. It's 3 pillars. So it's not just about capital. Capital is important, but it's not just capital. It's also a second pillar, and if you see, it's the same, they're equivalent, they're just exactly the same, the pillars of importance. The second pillar is risk management, is governance, and the third pillar is transparency, disclosure. All these pillars interact with each other, and the roof is group supervision. Group supervision, which is the most difficult area of insurance supervision, because it requires cooperation between supervisors, national supervisors. As you know, a supervisor always thinks he is God on his national territory. So if you meet many gods at the same time, you need to have an arbiter to make sure that they cooperate, and you need to organize that. And it was one of the most difficult issues to negotiate under Solvency II. Now, the main characteristics, you are familiar with that: market consistent valuation of assets and liabilities. There's a lot of debate today about what it means for liabilities. It took Europe 30 years to agree on how to discount insurance liabilities. And if you ask the insurance industry today, are they happy with the outcome, they will say no. It's still not perfect. I agree it's not perfect. But propose me something better. That is the question. And today there is no book on financial mathematics that you find in the world that deals with a world as we have it today. So we need to be creative, imaginative, in order to make sure that we can stick to the principle of a market consistent valuation, because anything else doesn't make sense in an economic risk-based approach. A total balance sheet approach, we look at all the risks, both sides of the balance sheet. We have 2 capital requirements. Why did we have 2 capital requirements, ladies and gentlemen? Could we not do with just 1? We wanted to make the actuaries happy. They can calculate 2 capital requirements. But there is a logic to that. The logic is that you have a first capital level, the solvency capital requirement, which is a confidence level, which is not 100%. And the capital may go below the SCR. And if you breach the SCR, ladies and gentlemen, it doesn't mean that you're broke. It's a natural thing to happen because of market volatility. And there are supervisors in Europe today, they say that you need to have an SCR of 150%. My answer is bullshit. Nowhere in the law does it say that you need to have a solvency capital requirement that is 150%. When your SCR goes below the 100% prescribed by the law, what happens? You get a call from Paul. And Paul will say, can you join me for a cup of coffee? And that's what it is. Because it was meant to be a time at which the supervised entity and the supervisor get together to look at the capital position of the undertaking to see what is happening. Maybe it's just the volatility of the market, and the next day you're okay. There could be something serious that needs to be taken care of. But it doesn't have to be something serious. But it is a time, and very important, of the dialogue. In the old days, the supervisor was using a monologue. Now, a dialogue, ladies and gentlemen, is not two monologues. A dialogue is an interactive conversation between two parties. And that's something that we all need to learn. And I've said sometimes in my presentations that it means basically that you have to look at your supervisor as your friend. Wow, that is not easy to understand. You can use an internal model to calculate your SCR. There's a lot of discussion about that. There are not many internal models approved today in Europe. There are many reasons for that. One reason is that many insurers believed that they know their risks better than they actually did. And when they came with their data on internal models to the supervisor said, where is your documentation? Oh, documentation. We've got this brilliant guy. He knows everything. He's a quant. He knows all the risks. It's in his mind. No, I want documentation. I want to know how you calculate your risk. And you need to use it in your management. So the other reason why we have not that many internal models is, of course, that insurance supervisors are not used to work with internal models. And that the insurance industry sometimes is a little bit afraid to go to the supervisor with an internal model. You can use partial internal models, you can use full internal models. It is my guess that going forward there will be more internal models. Certainly more partial internal models going forward. Three-pillar approach followed by the banks. The banks were always jealous that the insurers did not have a three-pillar approach. Now we have it. Extended and fully harmonized supervisory power is very important. Very important. You cannot operate Solvency II without a high-quality supervisor. How can you have a high-level dialogue if one of the parties to the dialogue doesn't understand what is insurance? So you need to have that. They must have powers to act, to react, to intervene when necessary. And group supervision is equally important as solo supervision, particularly important for a country like Romania. Because you do have foreign operators that have subsidiaries in your country. Can you believe, ladies and gentlemen, I've heard supervisors tell me, Karel, we don't need group supervision because I am in charge of supervision. I tell you, ladies and gentlemen, there is no local supervisor that can do his job properly if it is a subsidiary of a parent. I want to know the parent. I want to know what's going on in other parts of the group. That's absolutely crucial. It's not something you do on Sunday after the morning mass, It's something you do every day. Group supervision is absolutely crucial. Brief history, that's what the chairman asked me, very brief. A few bullet points. We start at the beginning of the century, 4 stages, 4 levels, commission, supervisors, EIOPA, CEOPS first, in close cooperation with stakeholders. The Framework Directive 2009, amended by Omnibus II, adopted after the financial crisis, implementing measures, implementing technical standards, guidelines, start date, as you know, 1st January 2016, and we have 31 countries in Europe applying Solvency II. How do I get to 31 countries? We have the 28 member states of the European Union, still today, and we have 3 member states of the European Economic Area. That makes together 31 countries. 4,000 insurers. What you need to know? It's not a zero failure regime. It is not impossible for an insurer not to meet the solvency requirements. Let's be fair. If I am an insurer who has been concluding life contracts promising a fixed guarantee over 30 years of 9%, and I have a return of my investments today of 0.5%, I don't need to be an actuary to know this is not going to work. We need to do something about it. So let's be fair, It's not a zero failure regime. We do accept, and let's learn in Europe, contrary to the US, where they have done that a long time before us, let's try to learn that we can fail. And let's think about what should happen if something fails. Solvency II will more quickly show when an insurer is experiencing difficulties. The low interest rate environment. Solvency II will show that, right? Because in the valuation of your assets and your liabilities. Moving from Solvency I to Solvency II made it necessary to have transitional measures. As Solvency I was not sufficiently risk-based, I've explained that to you, and that we need a different relationship between supervisors and the industry is also evident. Early lessons. It is very important, ladies and gentlemen, that the level of debate between the industry and the supervisors gets more professional. And I must say, I've seen already today that risk management, the way insurers today talk about risks, is very different from what used to be, because of quiz exercises, because of stress tests and so on. In the same way, supervisors talk about this in a more professional manner. And I can say that because I was there around the table at the first meeting of SEOPS, the predecessor of EIOPA. When all these Europeans were sitting around the table, it was a big table, you know, 31 countries, 3 per country. I mean, you need quite a big table to get these people around the table, all speaking the same language. Well, in their own way. The French a little bit with the French accent. The Germans also with the German accent. Everybody with their own accent, but they tried to understand each other. It was very difficult. And initially, they did not understand each other. So it took a while. That has all changed tremendously. So good. The third bullet point is very important. Anybody in this room who has ever tried to talk about the European insurance industry will have gone through the troubles that I go through every year when I talk to my students. There are no data on the industry. You go to the website of Insurance Europe, you find the latest data go back to maybe 2014, and then half the member states, and for life and non-life, they don't have it. They just don't have it. We have not in Europe a good database on the industry. And I do remember in the middle of the financial crisis, the finance ministers asked the Commission, so my commissioner asked me, what is the likely impact of the failure of Lehman Brothers on the European insurance industry? So I said, I'm going to ask EIOPA, was SEOPS at that time. Oh, they said, we don't know. There was no way they could know. In banking, they do it within seconds because they have the data gathering system. Ladies and gentlemen, note with me, historical achievement in Europe. For the first time in European history, we will have detailed data on the European insurance industry. That is fantastic, not only for academics, but also for the business people. You will know much more about your competitors than you ever dreamed of knowing before. That is important. We can better operate, we can better supervise when we have data. Insurance and insurance supervision is taken more seriously, also by banking supervisors. That is important. Why is that important? Because in many countries, it's the central bank now that becomes the supervisor. And what do most central banks do when they get insurance? The parliament says you have to supervise also insurance. You know what most central banks says? Let's move these people out and replace them with good people, because they have no respect for the people who do insurance supervision. I usually say banking supervisors travel first class, insurance supervisors second class. A banking supervisor or a banking person, when he gets called to reception, he goes in the middle of the room. The insurance supervisor or the insurer goes somewhere in the back, hiding. You know. It's a mentality, it's a different mentality. So we are taken more seriously now because the bankers can understand that we talk about risk management, that we have the 3-pillar approach. They must admit that our system is better as it is than the Capital Requirements Directive. And supervisory colleges are playing an important role in furthering a single European rule book. The supervisory colleges, which must be in place in all 125 groups in Europe, They talk to each other. There is a group supervisor identified, agreed between the supervisors, and they discuss issues that are relevant for the group. And that is very important because it creates a sense of buy-in from all sides. Again, it's not because you're supervising the subsidiary of a group that you do not need to know what's going on in the group. Similarly, if you are the supervisor of the parent and you don't know what's going on in the country where the subsidiary is placed, you also have a problem. So that is very important, and that is, I think, also recognized. Some of the challenges that we have operating Solvency II. The question is the system not too complex? And you can rightly ask yourself the question. We have a framework directive. We have a delegated regulation from the Commission. We have a number of implementing regulations. Then we have the guidelines. In total, Insurance Europe has calculated around 3,000 pages of literature. Who in this room has read all these papers? Yeah, I mean, you look a little bit tired, so maybe you, you have, maybe also after lunch, I don't know. But very few people. It's a little bit an unfair question also. But the point is, ladies and gentlemen, that's why I put this down here. It is so important that we concentrate on the substance and not on the form. Nobody in Europe can comply with all the rules and regulations that we put on paper. Now you're going to ask me, why did you put them on paper? First of all, I did not necessarily put them on paper. Other people did them on paper. Why is that? I explain to you. It's very simple. We started with a principle-based approach. And I invite all of you to go back home tonight, well, also to stay here after the party, but then to read the 60 articles on Solvency II in the Framework Directive. I'm very proud of those articles, because this was the summary of over 1,000 pages of advice from SEOPS. We summarized it in 60 articles. Read these articles, ladies and gentlemen. Then you know what is Solvency II. And that's where our focus has to be. Not whether in form ABC you filled out paragraph 56.58 or whatever it is. Let's concentrate on the substance. That is very important as a message to you as insurance industry, but also to the supervisors. It'll take about 5 years before everybody gets sort of settled into Solvency II. That's normal. That's true with all major reforms. So let's not do that. But why did it become so complex? Because I had the principles, and then people came to me and said, Karel, but what does that mean? I said, don't ask me the question, because I'm going to give you an answer, and you will want me to write that answer down on paper. So, and then the regulators came. The industry said, if you don't be more specific, the supervisors are going to ask me to do even more. So be specific. I said, okay. And then the supervisors came to me and they say, principles, I'm not so sure. Unless it's clearly in the law what I can do as a supervisor, the industry will oppose it. So the industry was pressing for more rules. The supervisors were pressing for more rules. And then EIOPA came and said, we want a European approach. So you can't be very general. You must be very detailed. Otherwise, the British will do it à la British, the French à la France, the Germans of Dutch, and so on and so forth. Italians all'italiana, bolognese, I don't know, whatever, una sauce. All the people will do that. So then EIOPA also wanted more rules. So you had a combination of all these parties wanting more rules, which gives you the 3,000 pages. But again, let's concentrate on the substance and not on the form. And I do not exclude that some of these rules will fall away because people will see it's not necessary. How will the market react upon the publication of the first SCR and MCR amounts? That will be next year. I invite you here in Romania to prepare your market for this. Already today, some companies are releasing these numbers because they're listed. They need to do it for the securities markets regulators. Other companies will do it because they just happen to have a very nice SCR, and they say, I got a 400% SCR, and you, you won't tell me, would you? You know, so you will have that sort of behavior of the people in the market, but you need to prepare the market because it's obvious that a number of companies will no longer have a solvency ratio of 200, 250% as they could have on the Solvency 1. You need to tell the market that these numbers are incomparable. And that even the SCR amounts between companies are incomparable unless you know what transitional measures they're having been used, what long-term guarantee measures they have adopted, and so on. So it's very important to prepare the market for the release of these numbers. That is important. Is it helpful to change the calibration in the standard formula? Today, there's a lot of pressure from the industry. They say, well, we have no more investment opportunities. Find us some investment opportunity. And the Commission says, fantastic, we want growth, investment in infrastructure. So let's lower the calibration of investments in infrastructure. A fantastic idea. My question, ladies and gentlemen, where do we start and where do we finish? I remember the standard formula, the first one we developed, was like this. Then people came to me and said, Karel, this is punishing the small and medium-sized companies because the calibration is not sufficiently granular. I said, okay, let's go on. And it began like that. And then people came and said, Karel, we got a problem because if your formula is that big, I can't have an internal model anymore. So I said, okay, let's go back. So, and we finished somewhere here. And what we're doing now, we're exactly doing the same. Because if you have infrastructure assets, then you can also in property, you can say residential property, you can say commercial property, you can say private property, whatever property. You can go far. The question is, should we not be a little bit careful before starting to change? And to review parts of Solvency II before 2020, let's let the system settle down so that people get used to it. What do we do with insurers that are unable to meet the MCR? You know what that means? If you don't meet the MCR, you have to stop operating. You put on your computer. The first thing you do, I Google EIOPA. It's very easy. It's not difficult. You can organize that. The system automatically does that. That's where you know what's going on in your business. That's where you learn the new developments. That's where it starts. And take this as a, you like it. You know, they have interesting literature which they publish once in a while. So you can read it and you know what's going on. So they are the technical advisor of the Commission and the Parliament. They have the leadership for the development of the technical standards. They are represented in all the colleges of supervisors. So they know what's going on. They're responsible for developing common supervisory culture. I can tell you, ladies and gentlemen, culture in Europe is different. It's great. It's great when I come to Romania that your culture is different from the one in France or in Germany or in Italy. I love all the cultures because that makes Europe rich. That makes it interesting to travel. But I can tell you, when supervisors sit around the table, they also have their cultural attitudes. And the Brits have their way of doing things. And the Germans say, das ist bei uns nicht möglich. You cannot do this in Germany, you know. What did we say? We'll make it possible in Germany. You know, we have increased the possibilities, the powers. So we're trying, and EIOPA is trying to do that now. They're trying to write a handbook on supervision. A common supervisory handbook. So fantastic. Ladies and gentlemen, this is historical. I mean, these guys are writing a common supervisory handbook. That means that your supervisor in Romania will start to talk the same language as a supervisor in Germany and in France. So you don't have all these inventions of local stuff anymore. There's no need to add to what is already complex. Binding mediation, what happened in the past when the French supervisor and the German supervisors disagreed? What happened? Nothing. What happens today, one of them can go to EIOPA and say, you decide. So will the French and the Germans agree now? Of course, by definition, because they don't want EIOPA to decide, so they must agree. Peer reviews. This happened in Romania. Frankfurt flies into Bucharest. We're going to look what's happening here. They write a report about it. It becomes public. People know what's happening. So you cannot hide in your little, you're a big country, but you cannot hide in your little corner because Frankfurt is here. He's watching. We are watching you. I mean, Frankfurt is watching you. Cooperation with the European Systemic Risk Board. Very important, as you will discover as we speak. For those of you who might be interested in this, the whole debate about financial stability. There's a very interesting report published by the European Systemic Risk Board about insurance and financial stability, published in December last year. It's thick. You may not agree with it, but it's interesting to read. For instance, after the party tonight, you know. It's only 1,000 pages. Clear mandate, EIOPA, to further develop market conduct rules. EIOPA is very active in consumer protection because it's part of the mandate. And they have the two stakeholder groups, which I have mentioned, one for pensions and one for insurance. And my last slide, to remember. Solvency II was developed as a uniform regulatory regime. As a uniform regulatory regime. Finita la commedia. It's finished now. Whenever we wrote rules together in Brussels, people went home and started to rewrite the rules in their national capitals. That's finished. The very easy thing to do, I've said that to many member states, you take the framework directive, translate it, it's already translated in Romanian, and you just put it under the law and have the president sign it. That's easy. No, member states all trying to change and it's a uniform regime, ladies and gentlemen. The important transfer of regulatory powers to the European Union and de facto to EIOPA. Gold plating only allowed to a limited extent. I hope that if member states are gold plating, that there will be a reaction coming from Frankfurt or from Brussels. Stop it. Treat your citizens honestly and fairly, not bureaucratically. That is basically what I'm saying. Cross-fertilization of supervisory practice through the College of Supervisors. We can learn so much from each other. And the colleges are a perfect way to do that. More limited role for supervisors in host member states. I'm not going to give you examples, but I can tell you I've heard, and I'm going to Warsaw tomorrow for a meeting with supervisors, and I will also tell them the same message. I want to hear this. You know, host member state supervisors don't need to think that they are God. There's only one God, whatever his name. We have to learn to work together. And learn to work together means listen to each other. And it's not because I'm in charge in my own country that I have to invent a lot of things or make people's life difficult. That's not the objective of supervision. The objective of supervision is to make sure that policyholders in the group are properly protected. Also locally, but let's not exaggerate as sometimes happens. And lastly, imposing unnecessary local rules and requirements will have to be paid for by local policyholders. That's something you always have to keep in mind. If you want to develop a local market and you start by imposing all kinds of rules and regulations, in the end it's your own people that will have to pay for it without necessarily having any benefit from that. With that, Mr. Chairman, I wanted to stop this introduction, Solvency II, before I get carried on and you will rightly correct me that I'm stepping over my time. Thank you very much.
Thank you.